A very good morning, everybody. Welcome to the Flow Show. Start of a new week. Hope you all had a safe and peaceful weekend. I'm joined once again by my colleague K-Man. Morning, mate. How you doing?
Hey, good morning, Ryan. Good morning, everybody. Yep, I'm all right, mate. We're back in the saddle.
Good. And hopefully a nice warm saddle for you. A bit warmer than it is here anyway this morning. Seems to have hit winter already.
Yeah, it's getting colder, right?
Yeah, definitely getting colder. I'm sitting here with my free Bloomberg gilet on that we got picked up the other week.
Oh yeah, good idea.
Yeah, see. Anyway, right, let's get stuck into things. In China, they left their 1 year MLF rate unchanged, 2.5% as expected. However, according to Chinese researchers, speaking to the Securities Daily, they see more RRR and interest rate cuts this year. But they haven't got long to do them. They've only got a couple of months left. China has apparently also told some of its lenders to pour money into new car loans and consumer credits, reported the Nikkei. Sorry, let me set that up. 1 second. There we go. Get rid of that. So they've told lenders, apparently, according to Nikkei, to pour more money into car loans and consumer credit. Meanwhile, another report from Bloomberg saying that they are also tightening rules on short selling of stocks to keep the stock market propped up. Just something to keep an eye on this week. China is hosting its Belt and Road Forum Tuesday and Wednesday. The likes of Russia attending, so expect some headlines out of that one. Over in Japan, Finance Minister Suzuki told the G20 that we may need appropriate action depending on FX moves. So giving a heads up there that they may be looking to act again, or whether they acted again, we don't know still. And we've just had the currency diplomat chief, or whatever we're going to call him, Kanda, out some minutes ago, saying that interest rates are only one factor affecting FX. We need to respond appropriately to odd moves in markets. It did drop a line saying that one option is a rate hike when excessive moves are seen. But then he said that rate hikes to combat inflation may have adverse effects. He's not commenting on whether speculative moves are being seen now in the yen. So some left field comments there, Kay, from Kanda. New comments perhaps, but rate hikes talking about FX, but then rate hikes talking about inflation. Pretty much going the opposite way of what most of the world is doing at the moment with interest rates. What do you make of his comments?
Just it also depends on it depends on what kind of questions he got asked. But there's a bit of everything and nothing in there. I'm not going to read too much in it. Well, the market reacted by a whole 3 pips on the back of it. So yeah, I mean, we've been talking about it like a while ago, saying that if they would do something to the rates, it would be seen as a bit of a panic move, and that might actually have a very adverse effect on the currency after the initial knee-jerk reaction. So I'm not going to take this as a new factor. We can't completely dismiss that the market is reacting a bit to it, but I wouldn't take it for I wouldn't take it as a real message to the markets. Just like those guys are going to keep the markets on their toes, because we are so close to psychological levels. And what I do note is that, of course, you have the dollar side with last week's numbers while I was out, but that the main reaction in, let's put it in FX pairs, has been seen in the Swiss and not as much in yen pairs. The dollar yen remained relatively stable, so the de facto yen crosses are lower, but the market is still not on board with a stronger yen. Otherwise, we would have seen a bigger reaction on those yen crosses on the back of the Middle East situation.
Yeah, very much so. Very much so. Right, well, we'll look at the prices obviously in a short moment. We'll crack on with the rest of the headlines. BOE's Peel has also been out this morning and striking a bit of a hawkish tone, saying we are committed to achieving the 2% target. We still have work to do to get inflation to 2%, and falling inflation is not enough to say the job is done. He also says that persistent inflation is a key element that the BOE are watching. Also says that the official average earnings is looking like an outlier, but says, I think we are facing persistent inflation pressures, and that's key to how we think about policy. Now, obviously, you can't go through all that without chucking in a bit of a dovish comment, saying that we never want to overdo it on tightening. But more so, he has been a bit more hawkish. We do have the jobs report, well, part of the jobs report tomorrow. It's not the full, we don't get the unemployment numbers, the claimant count, anything like that. All we're pretty much getting is the wage numbers. And wages are expecting to stay pretty hot. So that's going to be a big thing for the BOE tomorrow. Still, whether they sit above that 8%, up near that 8% mark, that's going to be tough, because we have had these potential one-off factors or temporary factors like the NHS pay rises and bonuses and that sort of thing. But we've still had wages up around that 8% mark, even after some of that should have dropped off. So if it doesn't drop off this month, there's going to be some questions asked about that. But we'll look at that those numbers in a bit. ECB's Kazakhs says we're not expecting rate cuts in the first half of 2024, and that the inflation path keeps rate hikes in play. ECB's Simkus says wages are growing quite quickly, and that's something others are saying are not an issue at the moment. Strong wages, but Simkus seems to be thinking they may be. And he also says that all preconditions are there to stop PEP reinvestments early. This is probably going to be the big subject at the next ECB meeting, which is likely to see them staying on pause regarding hikes, but the QE discussion, as we've known over the last week or so, is becoming a big topic there. ECB's Lagarde says that there seems to be more policy lag in the pipeline than from past interest rate hikes. Right, just looking back to the data from last week, Friday, we got some import-export data. Just looking at the year-on-year numbers, export prices fell 4.1%, so not as much as they did the month before. Import prices also down 1.7%, again, not as much as the month before. So some signs potentially of further easing in price pressures. Although you'll notice that import prices on the month came in softer at 0.1% versus 0.5% expected. Export prices, however, rose. That's not such a bad thing. This import price thing is more going to be felt perhaps in inflation numbers moving forward. Then on Friday we got a crazy bunch of Michigan numbers. Consumer sentiment fell back, expectations fell back, current conditions fell back. Then we got quite a sizable jump in inflation expectations. 1 year inflation up to 3.8% from 3.2. The 5 year up 2 pips to 3%. So something there for the Fed to be concerned about. Now, the only thing I would say is, this is a consumer survey. It's run on some 500 people who are phoned up randomly. Sometimes in these numbers, we can see gasoline prices and short-term inflationary effects popping up in that. But it will be something the Fed will be keeping an eye on, because it's quite a significant jump, particularly in the 1 year. Need to see if that continues. Flash numbers, so it'll be a week or so before we get the final numbers for that one. On the Fed side, Fed's Harker has said that the Fed is likely to be done with rate hikes, sees steadily disinflation or steadily inflation, and falling inflation falling to below 3% this year. Another one speaking on the tighter credit conditions, saying it's akin to rate hikes in impact. Over to the Bank of Canada, and some quite hawkish comments did for dollar CAD Friday, after he came out with saying that the Governing Council is to focus on whether they will stick with a 5% rate or if more action is needed to restore price stability at the next meeting. Then he's not really seeing a downward momentum in underlying inflation and says that is a concern. Going a bit against the grain and on the tighter financial conditions and what yields do in terms of extra tightening. He said higher long-term bond yields are not a substitute for what needs to be done to reach the inflation target. Also says that the bank won't be forecasting a serious recession at the next meeting. So we're getting to forecast with that meeting. Maybe they're going to be forecasting a less than serious recession, who knows? But anyway, we've noted here on the show last few weeks, the BOC, the data even turning a bit more hawkish, and Macron pretty much opening the door to a rate hike, whether it's this month or later on in the year. We will wait to find out. The BOC is going to be the first of the majors to drop their next monetary policy announcement. JP Morgan CFO was out after the earnings on Friday, and a pretty decent set of bank earnings coming out over there, so certainly no worries there. And the CFO of JPM says we are not seeing consumers feeling acute pain yet. Right, coming over to the geopolitical front, we saw on Friday a lot of risk unwinding, shall we say, in various assets. The dollar found a bid, quite a strong bid, knocking euro dollar all the way down, back down to the 105 level, a test of there. The dollar was bid even while yields came off. Let's get the right thing first. So US 10s again found a bit of a bid late on Friday, or through Friday. So knocking down from the CPR highs it made around a 4.7% that day on Thursday. Little bit of a gap up. What the market was doing on Friday was just unwinding positions more than parking a lot of money in safe haven flows. There were a couple of safe haven flows like gold that saw a bit of a pickup, and the usuals, Swissy and the yen, in smaller parts, shall we say, than perhaps normal. So more, as I say, an unwind of risk. No one wanting to hold any bags, big bags over the weekend. That has proved that there's no real big news happening over the weekend, no invasion or incursion, whatever you want to call it, by Israel thus far. Their 24-hour deadline for evacuations in Gaza is still ongoing. That could be down to political pressure from elsewhere to give people more time. That could be down to Israel needing more time to actually build a big offensive. We don't know. What has been going on persistently is the comments flinging around between Iran, Israel, the US and others. So we've seen a little bit of a risk rebound this morning. Probably, as I say, the fact that no poo hit the fan over the weekend. I don't think we're out the woods at all. This incursion, this exercise, whatever Israel's going to do, hasn't happened yet. Egypt has opened its borders for aid, so there's things going on underneath that we need to be aware of. We're in headline flux at the moment. All it's going to take is one bad headline, and risk will take a knock again. Conversely, if things calm down, then we're going to see risk rebound. So for now, it's really a case of just watching the headlines and seeing whether we get anything strong or weak on it. I know you haven't been, I don't know how much up to date you are on things with that side, Kay.
Well, it's not so difficult to be up to date. I mean, wherever you are, the headlines everywhere are flowing in. All news bulletins are only talking about that right now. Yeah, I mean, the situation is fluid, right? Nothing's looking well. I mean, it's looking temporarily a little okay because they're letting people basically flee the area where the hottest combats may take place. I'm not going to speculate on anything on that side. It's just impossible to speculate. Just a human tragedy again. But yeah, for us watching the markets, I think it's just too early to take any to take any lesson from what's going on. It's as you say, I mean, there's a flux of headlines. We don't know what's going to happen once they they close this window of the opportunity for people to leave the zone. Sorry, what is true is that Iran is putting oil on the fire. Saudi Arabia doesn't really know what to do. The Chinese are, and they can play a role somewhere, even though they are a bit far from the real action. But they are seemingly siding with the side of saying that Israel shouldn't overreact. I think the countries around are not really helping the situation. Let's put it that way. So I think it's still a very hot, too hot a situation to really start to make or having hopes that things will be contained to that one zone and even things calming down. So for us in the market, I think it's too early to make any decision. And as seen on Friday, and I was commenting on that quickly this morning in the chat room. It does seem, I've been watching stuff from a distance, right? But it does seem that finally the real risk pricing has actually started, and we can't ignore this gold move up from it took more than $50 at one stage, right? 60 bucks or so. That is what we as traders need to monitor. If you take only that, what the moves in the market, right, and not considering anything else. But we also know about how collective Alzheimer is a well-known disease in the markets, and if things would stay relatively subdued or confined to one area, precise area, the market can calm down a bit. So will gold and silver likely. But if the conflict persists, we see what the possible moves are. And now, one thing I would like to immediately tell our audience is that those kind of moves are which are linked to war and really high risk, those can be repeated. And why not? I mean, if really the proverbial shit really hits the fan, I wouldn't be surprised if gold hits 2,000 just in a couple of hours time. You know, it's this is a very different situation than just trading charts and technical levels. This is a run for the exit if the shit really hits the fan.
Yeah, very much. And I think that's the important message for traders. You know, before this all kicked off, we were trading certain things, trading fundamentals, trading the data, trading central banks. And what's happened is this event has come in over the top of all that, and it's changed how markets function. It's moved them into different thoughts. So, you know, plans that we may have had not even half a week ago have changed potentially. You know, we've seen the dollar strengthen even while yields came off. It was completely the opposite last week. And you've got to recognize these moments. And as Kay mentioned, you know, we look at charts, we look at our techs, you know, people run into safe havens don't look at charts. They don't look at fibs. They don't look at moving averages. If they want to shift their money into safety, they're going to do it, and they don't care about coloured lines on a chart. So we have to acknowledge that and do the same thing. You know, you've really got to set yourself wider on your charts. You know, we had you take gold, you know, we had it hitting the 1885, a level everyone was talking about. Boom, Friday went through that, went through 1900, went through all the levels. Then, you know, at some point it's going to run into trouble. Where it runs into trouble, you have to wait and see. It happened to run into trouble around the 1930s. It has been in the traffic area. But that looks to be a decent stretch point for the move we saw. So that's what you've got to look at. You know, if we get another risk-off headline, you can forget the 1930 area. We're probably going to be up 1960s, 1970s. Then you want to be looking at your stretch points, maybe into a bigger level up here. This is when your techs may become important again. But like I said, if he wants to take it to 2000, it's going to stop there maybe for 5 minutes before going on. So be very careful with your techs at this point, depending on the assets you look at, because they're not going to stand for much on a big headline. What you can do to counter that is, while you've got this volatility, while you've got this risk, bring your trade sizes down. If you have to trade, if you feel you want to still trade and you want to trade your levels, then do it with less risk, because that's what the market's doing. Okay, that's why we saw these moves on Friday. You know, hedge funds, investors, whatever. As soon as that Israeli stuff kicked off, not this week, last week, the first thing they would have done is gone, what's our exposure to that area? You know, are we happy with our exposure? If we're not happy, do we want to cut it? And then they came into this week and thought, right, this week is a bit of or this weekend is a bit of a risk weekend. We might get some big headlines. Do we want to be holding as much as we are that could be affected by that? And that's why you see people getting out of positions. And we should do the same. We need to protect our accounts against volatility and things we can't control. So bring your trade sizes down. You want to just get over this hump until hopefully, you know, there's a peaceful resolution, let's say, and we can go back to trading the central banks and everything else in the meantime. Because you have to know what is weighing on markets more. It's not the Fed, it's not the Bank of Canada, it's not the BOE, it's the Middle East stuff. And so you have to adjust your trading to know what the market wants to trade as well. So for gold, yeah, you know, it could go either way. You get a good headline and we're back down sub 1900. Another wonky headline and we're higher up. So, you know, you can't really pick a side at the moment. You can't look at this and say, oh, you know, a lot of people, oh, this has rallied, you know, over $100. I'm just going to start selling it and shut my eyes. Can't do that. Stocks were a similar situation. You know, as mentioned, we got those good headlines, good banking numbers coming in. But, you know, we got a decent rally all the way up there, and then the risk factor took over and the floor fell out of it. You know, I pretty much said on Friday, I think, I can't remember if it was out. If you're looking for a possible trade, look for the market to get bid up on the banking stuff, on the earnings, and then hit on the risk side of it. And that's what happened. You know, hopefully you made a few ticks from that. But again, this was the market saying, trading one thing and then the other thing coming over the top, the risk event coming over the top and exerting the pressure there. So this morning we've seen a bit of a bounce in risk. Again, but it's looking, you know, take euro dollar. We came down to here on Friday, held the 105, give or take a few pips. We've bounced a bit, but it's looking a bit dead cattish. This move looks purely, okay, the shit didn't hit the fan over the weekend, so there's a bit of a relief, but it's not a big bounce, 30, 40 pips. So the market's still unsure what to do. Again, another risk-off headline, bang, we're going to be going through that. The 105 probably. Get some peace talks popping up, we'll probably be at 106. So it's a bit hard to as I say, pick a side in any sort of trades at the moment, and trust the tech levels. Before we go further into prices, we'll have a look at what's coming up this week on the data front, because it's still valid. Today we get the Empire State Manufacturing, so that's the first manufacturing from the US of the new month. Keep an eye on the CAD numbers this week, obviously with the Bank of Canada being the first central bank to report in a week or so's time. The numbers are going to be important here, particularly to back up or not what Macklem said. So the business outlook survey is worth just keeping an eye on just for that sector. What's going on there. Tomorrow's mentioned, it says the labour market report, but it is only the earnings numbers, the wages numbers. Germany Zoo, we get to see whether things are still pretty crappy over there. Housing starts from Canada, CPI, big number there for Canada, the CPI report. If it goes up again, that'll be the third month on the trot CPI rises in Canada. Last month, the core went up as well. Retail sales tomorrow for the US. So again, that look at the consumer. Are we feeling any pain over there? On Wednesday, we get some Chinese GDP numbers and a load of data from those guys as well. It's going to be interesting for the one. UK inflation numbers. So we're getting some good numbers coming in here for the market, for the Fed to trade all the other stuff. It will have a say in things, but you've got to watch for how risk wants to take these numbers. If risk is still buying the dollar, risk off is still buying the dollar, you get a strong UK CPI number, you're going to see cable rally, and it's likely to be faded if the geopolitical risk is still stronger. Eurozone inflation as well. So into Thursday, what have we got there? We've got Aussie jobs, the LPR in China. Then coming in to Europe, not really much business confidence. I think that contains a consumer confidence in France as well. Then we get the Philly Fed next manufacturing numbers from the US, PPI from Canada, housing numbers from the US. Into Friday, UK retail sales and Japanese PPI. We're going to need to keep an eye on. Are things still sticky over there in Japan? That's going to influence as we creep towards the BOJ as well. And Canada retail sales finishing off Friday for Canadian dollar and the BOC. Quite a busy week, Kay. Anything you're picking up as your highlight for the week?
Yeah, if you look at those numbers, I agree that on the Canadian front, it's still looking, let's say, up. If you look at the Canadian dollar, so those data, if we get confirmation of better data or higher kind of data, like for instance those retail sales, but that's towards the end of the month. But also on geopolitics, if the oils continue to be bid on the back of everything we are seeing, then I think the Canadian dollar is one to that could actually have a pretty decent week despite risk off. The Canadian dollar is one. Yeah, as Gavin says, we've got Powell as well on Thursday. Just before the blackout into the next meeting, right?
Yeah, I think blackouts.
Yeah, and then there's one thing that's standing out is a big word because it got like pushed a bit into the background, but China had their biggest week of liquidity injections last, apparently. So they're still trying to keep, or they're still actually managing to keep CNYH within their acceptable zone, but has to be said that even without touching the rates, I think they will have a bit of rates as well later this week. We've got the GDP out on Wednesday as well. That could be an interesting one if that would disappoint, but then it's of course it's the Chinese bringing out their own data. We never know. But I'm just looking at the liquidity front and the watering down, further watering down of finances. Really, is that I think it should keep the Chinese yuan a little bit in check, and perhaps if we get more bullish dollar news out or safe haven buying, that 732.33 on the dollar China will be retested, and that's what I'll be looking at as well. On the broader side of things, and since we started to look at a few rates, I guess on the broader side of things, one that is not really attractive to me. It will move, but which is not really attractive to me is the yen right now, because we are in a situation where, and as we've seen over the past sessions, that the Swiss is really the main risk of currency if you look at FX. But just keep it on. Oh, sorry. Yeah. So I mean, this one is not really attracting me to trade a lot right now, and sometimes it's equally interesting to see what we don't trade. It's kept up by those higher yields, but then there's a bit of like risk off stuff going on in the yen crosses, but then it's pushing and pulling, and even not thinking that the Bank of Japan or the MOF may intervene or not around 150. This one could be a bit of a tough one to trade to start the week. Not really attracted to anything. I usually have a pretty good idea about what I want to do in yen, and my long-term view is unchanged. But right now, I think I'm going to leave that one alone. Perhaps if we get a decent setback lower, so that is yen a bit stronger, I'll start to look at perhaps a few currencies. But yeah, for the time being, well, I'm still a bit long dollars from last week. Not planning to change much to that right now. But I mean, the rest is yeah, my long-term silver is still there as well, but for the rest is going to be case by case trade. What I do note though is that with all the risk off that we've seen, is that MEX, for instance, of course, it's a US neighbor, is volatile, but it's not weakening on the back of risk weakening elsewhere materially. So that's an interesting one to note. And even the rand has stopped weakening in this whole thing. So emerging markets have responded, but then at the start of the conflict, but have since stabilized. And that is where I'm talking about the market is suffering from collective Alzheimer. Is something that we also need to look at, is that a conflict like we're seeing now is mostly the market trades it for a week, couple of weeks, and then see and judge how the evolution of the things are, rather than if the conflict is still ongoing. And we have an unfortunate good example from that is Ukraine, right? It didn't stop oil and gas from at one stage weakening actually materially, even though the conflict is still ongoing over there. So those are like somewhere the big lines that I'm trying to keep an eye on. It's for the rest, it's more like once you look at the big lines, in my opinion, it's more like a case by case. You can have like a one-day move somewhere, but I'm convinced right now, and I do think that the best approach right now is, if you do anything that is just chart or technicals related, or you see a move, it's paramount to protect your profits as well. as Ryan was saying, we come out with, well, we have been trading fundamentals. There you can keep your positions for a while, trade it in and out if you like, slice and dice, keep it running. But now if you do anything shorter term than what you think the global picture is, you really have to take your profits very quickly. If you see a quick move in your direction, your account will thank you if you at least take bits and pieces off, and that's my firm plan for the start of this week anyway.
Yeah, good advice, mate. You know, if you were long gold and you got that hit up into the 1900s, you know, you should be taking some money off the table, because if it changes, then we go all the way back down again. But yeah, I agree with all that, Kay. I mean, it is a bit tough. Dollar yen, I mean, it's just stuck in the middle. You know, you've got yen on one side with a bit of a safe haven plane, and then you've got the dollar strength on the other. This to me is still just a whole big mess since that day. You know, it's just injected so much uncertainty into things. No one still, I don't feel, really wants to push it either way, because you know, sellers is going to cost them to sit in shorts, and they don't want to fight against the fundamentals. But then longs are wary of what happens if we get to 150 or not. So for me, I'm just going to keep watching 150, 147, whatever it does in the middle. It can just go and do its own thing. Who wants to look? Demetrius wants to look at Euro CAD. Yeah, that, I mean, I'm still I'm favouring a CAD bullishness, as I've been for quite a while. But again, this risk stuff is over the top of it at the moment. So in terms of what you want to do with this, you've got to watch this data. If we get weak data in Canada, then something like EuroCAD is potentially going to go higher because it's going to reduce the hawkishness for the BOC. In that sense, you may not want to be short it. But if you want to short it from the euro side of things, that's a different kettle of fish. So a rally in EuroCAD, obviously you've got to keep an eye on oil. That's moving on the Middle East stuff as well, which is going to have an influence in CAD, although it's a bit on and off that correlation at the moment. So yeah, it's hard. You've got to look at what the data's doing, what the moves are doing, what the risk is doing. And if you're trading specifically for something like the Bank of Canada, then you either got to scale in if the data, if you think the BOC might turn more hawkish at the next meeting, you got to scale in to shorts in CAD pairs, as long as the data backs that up. If you don't think they're going to be hawkish, then you want to be looking at longs at these levels. So, you know, a bit of support down around the low 43s is where you're going to be looking. But if you're looking for shorts, yeah, as I say, it's up to you. Trade the technicals if you want, but know your risk. So if you get back up to 145s, you know, particularly if you get up to 146.5, our old mate up there, a long-term area, then that's maybe somewhere you want to think about initiating shorts if we go there, because that might be somewhere where the price pulls up. Kay, I know you're only just back. I don't know if you're up to date with your charts or anything. If there's a couple you want to look at, or you want me to continue.
I can look at a few, and just look at just to show people what's hot and what's maybe actually not yet, and one that is not yet telling me that it's really hot, even though I'm a bit short euro dollar, but that was more like is 106.35.50 going to be capped or not, which it did up to now. But coming back, we've had those moves. This is the short-term differentials, and you know I like to trade it when I like to really monitor this closely when I'm in euro dollar positions. And look, it's going up and down. It does have the occasional moves on data. On this is the start of the conflict in Israel, but if you look at it, we're still hanging around towards the bottom end of it, but hanging around in a pretty range, right? And I'm just going to repeat what I've said the last well, months really, is that to get a viable move in euro dollar, this will need to move. I think on the back of uncertainty, conflict, whatever, this is probably going to widen just a tad, because the dollar is going to find safe haven bids. So this is what we're seeing now. But for really levels to break on the euro, we are going to have to get out of all those ranges here. Okay, these are the big zones, right? These to me are the really big zones, and but we are already having something around 200 BPs. This is the inverted, right? If you see minus 1.923 where we are now, percent is the width of the difference between the Euro 2-year and the US 2-year. So to really break down in the euro, I think we need to go below 200 or wider than 200 BPs and stay there for a while, and then we can get into this zone. And by the time we would get into this zone, I reckon we are going to trade probably in the process of we should be trading below 104 towards these 103, 102s perhaps. But if we start to get back above tighter than 175 BPs, then I think the euro dollar would be ready for a bit of a retracement. And we've seen those little spikes and things, and but the euro couldn't break above 106.3550, where my zone was here. People in the room know that I've been monitoring this zone here, 35.50, as an extra layer to the break of this channel, which was, we have to say, it was like a really fast moving channel lower. So that's why I said, I mean, I rather watch this zone here. It starts to go above 106.5, then something might be changing. It didn't. We are back lower due to circumstances and everything, but also due to the higher US CPI data. And if you take the combination of the data last week and you take into account as well the NFP that we had the week before, to me there's still very little reason to be short dollars, besides some relief spikes on geopols or so. So we're back. So your first level should be somewhere around here, 105.65, 75. The resistance, we've seen that come into play a couple of times in past traffic as well, but we're still very reluctant, or the market is still very reluctant to take it below those prior lows, and that's due to those differentials. Differentials are not supporting big moves right now in the euro dollar. Sterling, actually, Phil, while we were already on the flow show, Phil said he expects CPI to come down to the 2% pretty quickly after all. But he's been like covering all bases basically this morning, and I don't know whether it's. I think ignoring him is a not too bad a strategy as well. Yeah, basically the cable. Okay, we've had this early October move, but basically we're still, which was a false breakdown. Then we had a move above my figure 20 zone, which was also a false breakup, and then I decided to just add a little there as well when I saw it go up, and then fail there in the cable. Little short on that one right now. It's within the range. To me, it's still 120.80 again, and then this 123 figure 20. That's where your ranges are. If we get back below 120.80, probably going to have a look back at this prior low, and then the psychological 120 figure 15 probably. But again, and let's do this live then. Let's do the sterling ones. Oops. Oh, did I not? Think I must have lost my.
It's your scale, I think. Your scale on the right.
This is not correct. Yeah. Okay.
Change it back. Change it to percent.
No, I've got it.
Oh, you got it there.
Yeah. Okay. If you look at it, so we had those jumps up and down, but then look at what we're doing. We are staying at relatively wider differentials because it's been positive, this cable. The sterling versus the US differential has been positive for a while. Now we are negative for a while, so that will likely see the cable capped at on bounces, but we are relatively stable. So heavy, yes, but we are not breaking fresh ground. I think if we break wider than the 25 BPs that we are now, this is probably going to be back at the 120.80, 121, the figure zone. If we start to break back down there, then probably cable is ready to go lower. Is it fundamentally warranted? I'm not sure right now. I am trading sterling from the short side again, but I'm also respecting those levels. So I've already taken a little bit off and then see what those differentials are doing as well. So basically, this is what I'm looking at for the start of the week. You look at what your differentials are doing, look at your currencies, and then unfortunately listen to the headlines. Gold. We've had these several trend lines and levels taken. This is looking a little bit more complicated than what Ryan was showing, but the levels are relatively clear. Your 1910, this is where we are resting on right now. This one is probably obsolete, but look at what's happened since we printed this high in July. 1, 2, 3 touches, and that's where we stopped, 1930. So if you want to hang on to a technical level in gold, keep an eye on what's happening at 1930, and then here this zone 1910 all the way down to 1900. Okay, 1910, 1900. If 1900 starts to go, perhaps something has changed to the geopolitical situation, or the market is in one of its collective Alzheimer moments and says like, well, it may all not be that bad. We don't need our protection anymore. And then it's likely that we are going to go back levels around the 1870s, sort of there. If we get more really bad news, as I said, this could just go because the people will really rush into whatever is risk averse, and gold is one of the risk averse instrument, as we know. Get into cash, get into different stuff, and this could really break and go back up, at least all the way down, all the way up to those 1980s. Silver has also turned up. We are also around some resistance, some sort of resistance, 2260 up to 2275. We're still there, trading 2055 at the moment, 2255 at the moment. It's going to be headline watching for this one. If we start to go back below 2230, then and confirm below 22, then I think there's a chance that people need to unwind the risk positions, and the dollar is getting a bit of a natural bid or so, or the yields creep higher. But if we get more, it's an unfortunate industrial metal at some times, and when war rages, this one also is one where the people will probably need more of it, and then we can see levels of 24 and a half. Why not? And really, Ryan, I think I'm going to leave it there for today, mate.
Yeah, thanks, mate. Thank you very much. Yeah, so keep an eye on those headlines. The market might think that things aren't going to be so bad 5 minutes down the line. I think it's all going to be about spillovers. If Israel does its incursion, but there's no spillovers into Iran kicking off and the rest of it, then we're potentially heading for another Ukraine situation where it's contained in its own little bubble, and the market goes back to trading other things. That's what we've got to look for anyway. Trade safe, be safe. Watch all that data coming out this week, when we shall see you all bright and early tomorrow. Have a great day, everybody. Thanks, Kate.
Cheers, guys.